Hello everyone, welcome one and all to yet another joint webinar on our series on doing business in United States. So this being part one, so there will be a series of 3 to 4 webinars, and the entire topic of doing business in US would span across those 3 to 4 webinars. Secondly, and more importantly, it gives us immense pleasure to announce that this webinar marks our presence in US, and we are now live in US along with our other foreign jurisdictions of Singapore, Dubai, London, Malaysia, and Africa. We have partnered with Square and Company in US, and gives me again immense pleasure to introduce Mr. Joe Hilsted, who heads the tax practice there in the firm, and who will also be additionally taking us through with the today's session along with Ms. Sierra. About Joe, yes, he, as I said, he heads the tax practice there in Square and Company, and he, more importantly, looks on corporate tax and allied laws. And his area of expertise includes taxation and more. Also, we have been interacting with Joe for quite some time, and we thought let us take this relationship to a next level, and that's where we decided to collaborate. And now, as I said, this webinar marks our first initiative of collaboration. So, over to you, Joe. Your thoughts on today's session, and you can take it forward.
Great, Jugal. Thank you for that kind introduction. You know, we have been working with Jugal and DVS for some time. We're excited about our partnership and DVS's expansion into the United States. So congratulations. We're so glad to be a part of it, and very glad to be a part of this part one, doing business in the United States. Like Jugal mentioned, I'm Joe Hilsted. I'm a tax partner with Squire & Company. We're a regional accounting firm headquartered in Utah. And with me today is Sierra Hoggett. She is one of my colleagues. She is a great tax practitioner, and very glad to have her help today. So again, thank you everyone for joining. We're excited to talk about doing business in the United States. So Jugal has placed a PowerPoint presentation up, so hopefully everyone can see that.
Yes.
Great. Okay, great. Yeah, I think that does it, Jugal. So yeah, you know, I think before we get into some doing business in the United States, I think everyone is familiar with a little bit of the geography of the United States. You know, obviously we've included all 50 states that make up the United States. Sierra and I are located here in Utah, which is commonly called the crossroads of the West. If you're familiar with Utah, we are in there are lots and lots of mountains. It's a high, Utah is known for its skiing, its beautiful mountains, its snow, and also in the southern part of the state, it's known for its red rock formations. So in fact, this is the mountain where Sierra and I live, and this is exactly what it looks like right now. We just live in this valley. This mountain is called Mount Timpanogos here, and we just live here. Beautiful mountain with snow-capped peaks there, and on the back of the mountain, there's many ski resorts there. So if you get the chance to come to Utah, you've got friends here, and so we'd love to have more friends here join us for skiing. As I mentioned, in the southern part of the state, it's known for beautiful arches and red rocks and things like that. So just a little bit of background of where we live here in the western part of the United States. Just to give you a little bit of an overview, right? The United States has about 328.2 million people. Here in this map, you can see the population by states. The darker blue means more population. The lighter the color is fewer population. So as you can see, California is the most populous state here in the Western United States, where, you're probably familiar with San Francisco and Los Angeles and San Jose and Silicon Valley in the Bay Area, right there. California has almost 40 million people, but its economy by itself, just the state of California, is the 9th largest economy in the world. So, significant place to do business, known for, Silicon Valley, known for technology. If we keep going, Texas is the 2nd largest state with 28.9 million. So a little bit lighter blue. Then Florida is the next, 21.4 million. New York, right here, the state of New York, has 19.4 million. Other populous states, Illinois, that contains Chicago, Ohio, Pennsylvania, for example. Utah only has 3 million people. And then, some of these other lighter states where the population is even less. So just a brief overview of the United States. A couple of things, as we talk about the U.S., we've obviously been hit hard by COVID-19. And just a few stats about that impact of COVID-19. We have found that small businesses have been particularly hard hit by COVID-19. Revenue is down 20% since January of 2020. Bankruptcies have increased significantly relative to last year. Fortunately, there are 2 types of bankruptcies here in the United States. There's what's called Chapter 11 bankruptcies and Chapter 7 bankruptcies, but only Chapter 11 bankruptcies have increased relative to last year. During that spring, for us, COVID-19 really impacted us in March and April. That was the most severe portions of this pandemic. And we found that new business formations have fell significantly, but now there's been an uptick since the pandemic started. And we think that the formation of small businesses will increase and it will outpace recent years, which is good news. The numbers of labor force participants that were not at work quadrupled from January to April of 2020, right? Significant impact there in the spring of 2020. And then the number of people not in the labor force who want a job spiked by 4.5 million in April of 2020. Fortunately, that number has come down as we've been able to manage through the pandemic. In April of 2020, the U.S. personal savings rate reached its highest recorded level. That's good news, but many people have been able to eat into their savings, which is unfortunate. Low-income families with children were most likely to experience an income shock, right? The COVID-19 pandemic has really impacted low-income families, unfortunately. And then this last statistic is in 26 states, more than 1 in 5 households was behind on their rent as of July of 2020. Some significant impact as a result of COVID-19. We are finding that there is now a big spike in the number of positive cases, mainly a result of the recent holidays here in the United States with Christmas and New Year's. Families, we're meeting where possible, and so we think that there's been a lot of the spread recently. We hope that will come down, and we're very hopeful for the vaccine, and especially hopeful that the economy can return back to normal, to pre-March of 2020 levels. Let's give you a little bit of an overview on what's happening in the political environment here in the United States and what that impact is going to do on the economy. I imagine many of you have been watching the U.S. presidential election. President Joe Biden, or President-elect Joe Biden, will be inaugurated as the 46th U.S. president on January 20th. Prior to this election, there's been some significant unrest here in the United States. I bet many of you have heard of some of the Capitol riots that have happened in Washington, D.C., with President Donald Trump supporters storming the U.S. Capitol. That was very, very unfortunate. Some people lost their lives. We have not seen that type of political discord and unrest for some time, which is very, very unfortunate. At the same time, Donald Trump, the 45th president, will leave office as president on the 20th. He has now indicated that there should be a peaceful transition of power. So what does that mean? Well, in the United States, there are three branches of government. There's the executive branch led by the President of the United States. There's the judicial branch, which includes the Supreme Court. And there's the legislative branch, which is made up of two parts. Those two parts being the House of Representatives and the Senate. Well, as a result of these elections that happened in November, the Democratic Party retained the House of Representatives, and on January 5th, there were two runoff elections in the state of Georgia to determine their two Senate seats. And what happened is that the Democrats have appeared to have won both Senate seats in Georgia, and so now the split in the Senate is 50 Republicans and 50 Democrats. But when there is a split, the Vice President-elect Kamala Harris has the tying vote. So effectively, the Senate is controlled by the Democrats. And so now we essentially have a trifecta. The Democrats hold the White House, the Senate, and the House of Representatives. And so, what does this mean? Well, it means that Biden's tax plan will be most likely passed here shortly, and those proposals under President Biden ultimately mean higher taxes here in the United States, especially for wealthy individuals. And President-elect Biden has indicated that those wealthy individuals are those that make generally over $400,000 US dollars. He has proposed to increase the corporate income tax rate from 21% to 28%, and has proposed to increase the individual income tax rate, which is right now at 37% to 39.6%. And Sierra and I will get into some of those other nuances as we go throughout this presentation. Let me just go on to the next slide here. Sierra and I, when we get companies that are expanding into the United States from around the globe, one of the questions we get asked frequently is, what is the financial statement audit requirement in the United States? Or what is the statutory audit requirement in the US? And the general rule is that there are no financial statement audit requirements unless the company is publicly listed on a stock exchange like the New York Stock Exchange or the NASDAQ. So only publicly held companies require certified public accountants to audit financial statements. However, private. Oh, Jugal, go ahead.
Yeah, I had this query. As you said, only publicly listed company have a mandate to do audit. Say if it is not listed and it is having a huge turnover, even that is not a criteria for any unlisted public company to do audit. I mean, turnover is never a threshold, as you rightly mentioned, and only if it is listed, it's a listed public company, then only there is audit requirement. So a private limited company or private LLC would not have audit requirement, even though they are having a comparatively high or a huge turnover, correct?
Correct. That is absolutely correct. Right. It doesn't matter. The private company's turnover or sales could be significant, and they could have significant growth, but there is still no requirement to have their financial statements audited, unless they have some sort of bank covenants, debt with a bank, a third party lender that requires a financial statement audit. The other scenario that we frequently see is that the board of directors specifically requires that privately held company to have a financial statement. But unless the bank debt covenants or the board of directors require a financial statement, there is nothing under U.S. law that requires it unless you are a publicly listed, publicly traded company. Yeah, very good question. Thank you.
Thanks, Joe.
All right, Sierra, I'm going to hand it over to you to give us a little bit of a tax overview here in the United States.
Perfect. Thanks, Joe. So companies in the U.S. are subject to separate federal, state, and or local taxes. The IRS, which is the Internal Revenue Service, which is the U.S. federal tax authority, collects income tax for corporate and individuals, capital gains tax, tax on dividends, interest, and other passive income, as well as employee payroll taxes. Additional taxes in the state, additional taxes are imposed from the states where these companies conduct business in. So this is a map that shows the state's corporate income tax rates. As you can see, Iowa probably has the highest rate at 12%, the dark red state. And then the lowest state looks like North Carolina at 2.5%. So you can see every state's corporate income tax rate, and the states in gray don't have corporate tax. So Nevada, for example, has no individual or corporate income tax. They get most of their revenue from sales tax in the gambling and mining industries. And then Texas puts a franchise tax on corporations. Washington has a business and occupation tax on gross receipts. And then Wyoming and South Dakota don't have any individual or corporate income tax. And Ohio also imposes a gross receipts tax.
Yeah, and thanks for that, Sierra. And so it's important to note, everyone, that U.S. corporations, U.S. Formed in the United States, and they can be formed in just about any state, are subject to the federal income taxing regime. And just like Sierra pointed out, they're also, depending on where their activities are or where they're formed, may be subject to these state corporate income taxes.
So in the US, a business is taxed, and how it's taxed depends on how it's organized. And the following slides are going to summarize the general tax treatment of corporate and pass-through businesses, because in the US, business mainly falls into those two categories: corporations and pass-through entities such as LLCs or sole proprietorships. So when you're creating a business in the US, you have a choice in entity, and the most common of these are corporations, LLCs, partnerships, and branches, but you could also have a joint venture or a sole proprietorship. So corporations are what we'll focus on first. These are organized under state law, and each state has its own rules for creating and operating these corporations. They might be created under the law of one state and have a principal place of business in another state. Most corporations, however, incorporate in the state where the business intends to locate their operations. To form a corporation, you have to get a certificate of incorporation filed with the Secretary of State in the state that you choose to do business in. C Corps are taxed at the corporate income tax rate separate from the company's owners, which is 21%, And then profits that are distributed to owners as dividends are taxed also to the individual level. So they're taxed twice. You also want to separate your personal affairs from your company business to prevent creditors from imposing personal liability.
Yeah, and Sierra, very well put. I think the point that I'd like to bring up on this slide is, we get many inbound clients that ask us about incorporating in Delaware or Wyoming or Nevada. All three of those states do not have a corporate income tax. And the thinking is sound. However, what we try to explain to clients is that those corporations, although they may be formed in Delaware, Wyoming, or Nevada, if they have operations in California, for example, they will still be subject to California income tax. And generally, we look to see where the business has a physical presence. That's the starting point, at least. There are more factors that go into that. And what we mean by physical presence would be, does the business have employees? Does it own property in the state? Property in the form of inventory or an office or a warehouse or a factory or a manufacturing facility, whatever the case may be. And so a common misconception is that if we form a Delaware corporation or a Wyoming corporation, we won't be subject to other states' income taxing regime. And that's just not the case. The only time that will happen is if the business's operations is solely located in Delaware, Wyoming, or Nevada. And so that's important to keep in mind. The other thing is that you will find that many institutional investors, like private equity, venture capital, they are very familiar with the business laws of Delaware. And that makes Delaware a very popular jurisdiction in forming an entity, whether that's a C corporation or an LLC. And you'll find that many of the publicly listed U.S. businesses are Delaware entities. If you look at their SEC registrations or their SEC filings, you'll see that many of them are Delaware entities because many of those institutional investors are familiar with the business law of Delaware there.
Joe, I've got a query in one of our professional group, not the one which is posted here, but the one in the professional. So if an entity is located in Delaware, as you said, there is no corporate income tax. But say, for example, it has a principal place of business in California. So it would be subjected to tax in as per the California corporate tax rate, correct?
Correct. That is correct. Let me give you an example, just the example that you just gave. That is, a business is formed in Delaware. It's a Delaware corporation, but that business employs individuals in the state of California, let's say Los Angeles or San Francisco, for example. That corporation, that Delaware corporation, would need to file a California corporate income tax. And what we do is we apportion income to California. California uses sales sourced to California as a fraction, and the numerator being which California sales divided by total sales, and that is multiplied by the net income of the business, and that is then multiplied by the California corporate income tax rate of 8.84%. But yeah, in short, exactly what you mentioned. If the Delaware corporation has activity in California, it will most likely be subject to California income tax.
Okay, great. Thanks, Joe.
You bet.
So moving on to limited liability companies, these are also formed by registering with the Secretary of State in the state where the company is to be created. LLCs are governed by the state laws where they're formed. They must have at least one member or owner. LLCs provide more flexibility with management and financing. Owners have operating agreements to govern their operation and organization as opposed to articles of incorporation, which corporations have. LLCs can elect to be taxed as corporations or have their income passed through to their members. Most foreign companies investing in the U.S. prefer to be taxed at the corporate level instead of the individual level because LLCs treated as partnerships require a mandatory withholding regardless of whether profits are distributed or not. And members' personal liability in LLCs is limited to their investment in the company.
Yeah, and I just wanted to point out a couple things. LLCs here in the United States are much more flexible than corporations. And what I mean by flexible is that they don't require the same formalities that corporations have. Those formalities that corporations have is in quarterly or annual board meetings, quarterly or annual board minutes, things like that. And for Sierra and myself, who practice here in Utah, which is a middle market type of market where we have lots and lots of small businesses and entrepreneurs who aren't necessarily good at keeping up with the formalities, they enjoy the limited liability company flexibility. And that's a data point for choosing that. For inbound companies like that may want to expand in the United States, the starting point for us as tax advisors is really a corporation. And the reason why that is because a corporation does not pass its income up to its shareholder. A corporation, a C corporation, is taxed at its level, and the control of dividends and the timing of dividends makes taxation better. In an LLC context, an LLC may generate a profit, and that profit requires a mandatory withholding regardless of whether that profit is distributed. And so for us, for a lot of clients that come to us and say we'd like to expand in the US, the starting point would be a C corporation, although it's not always the case. But there's a lot of considerations that we want to take into place. What are those considerations? Well, are there going to be profits that are going to be repatriated to the Indian parent, for example? Are there going to be intercompany transactions like management fees from the Indian parent or the Singapore parent or the Dubai parent, for example? Are there going to be royalty payments, things like that? So there's a lot of considerations we want to take into place in determining what is the best legal entity. Sierra, I'll go on to the next slide.
Perfect, thanks, Joe. So for LLCs, there's also check the box rules, which allow taxpayers to elect to tax the characterization of legal entities. So like I said, LLCs have the choice to be taxed as a corporation or a pass-through, and they have the default classification of being a disregarded entity or a partnership, depending on the number of owners, but they're eligible to make an entity classification election to change to a corporation for U.S. income tax purposes. Moving on to partnerships. So a partnership is when one party agrees with another party to do business in the U.S. A written agreement is not required, but it is advised. If you don't make a written agreement, a partnership can be formed through an oral agreement or by conduct without filing documents with the state. General and limited partnerships can be formed. General partners are actively involved in management and can make decisions on the company's behalf. There's not really liability protection for these partners. If one partner gets sued, all the partners can be held liable if you're a general partner. But if you're a limited partner, the partner would only be an investor, but they wouldn't be involved in the day-to-day operations. Partnerships do not have the same liability benefits as corporations or LLCs. Each state and the District of Columbia have their own laws governing the formation and operation of partnerships. And partnerships are treated as pass-through entities for U.S. federal income tax purposes. So their income or loss is passed on to the owners who report the income on their personal 1040 tax returns.
Yeah, and like Sierra mentioned, we don't often see partnerships. We see limited liability companies because of the liability protections that they offer. Like Sierra said, partnerships do not offer that limited liability protection, meaning that if a creditor were to sue the partnership, that creditor could potentially go after the personal assets of the owners, which is not the case for LLCs or C corporations. So in practice, we don't see partnerships too often. We do see limited partnerships which offer liability protection to the limited partners, but not the general partner.
Joe, we have one question here, Joe and Sierra. Whether there is a requirement to have a local director or a local shareholder for doing business in US under any of the corporation, be it partnership or LLC or corporation. So is there a mandate to have a local director, local resident shareholder for doing business, or uh, it is fine if it is 100% owned by a foreigner?
Great question. Yeah, the answer is that under U.S. law, there is no requirement that there be a local shareholder or a local director or officer. So in the case of a corporation, an LLC, or a partnership, you can have completely foreign shareholders. In the case of a corporation, you can have foreign officers and or directors. For LLCs, same thing. You can have foreign members. The owner of an LLC is called a member. That's the legal name for an owner of an LLC. So you can have foreign members, and the manager of an LLC, that's kind of the structure, the management of an LLC does not have to be a U.S. citizen or a U.S. resident. And same for all of the legal entities here in the United States. So unlike many jurisdictions, there is no requirement that there be a U.S. citizen, director, officer, or shareholder. Did that make sense? Did that answer the question?
Yes, Joe. I guess the answer provided provides much clarity on the foreign directorship and the foreign shareholdership.
Okay, great.
Okay, so moving on, we'll talk about branches next. So foreign companies are not required to conduct business in the U.S. through a U.S. entity. Branches are not like a subsidiary, so they're not a separate legal entity of the parent company. Branch offices are considered to be the foreign company operating in the U.S. Branch offices in the U.S. and conducting business in the U.S. are considered to be doing business in the United States. And although the United States has a worldwide income regime, U.S. branches would be subject to tax on their U.S. sourced income. Liability of the foreign company would not be limited to liability just at the branch level, so branches aren't really advised for tax and liability reasons. And intercompany charges like management fees, interest, royalties, and things like that may be more difficult to justify under a branch as opposed to one of the other choices in entity.
Yeah, just like Sierra mentioned, this last bullet point, we don't often see branches here in the United States for tax and liability reasons. Meaning that, if a foreign company wanted to create a branch office here in the United States and employ individuals and own inventory, any creditors could potentially go after the assets of the foreign parent. There would be no liability protection. From a tax perspective, we would treat that branch as a separate, distinct business, and it would be subject to U.S. tax. But the foreign parent would be the filer of the income tax return, which is not a very favorable thing. And so, from our perspective, we like to conduct business here in the United States through a U.S. legal entity. that entity would be responsible for both the income tax and any sales tax. We're going to get to that in a little bit here shortly. And so we just frequently don't see branch formation very often. We know that there are companies that want to test the market here in the United States and are cautious about forming a U.S. entity because they just don't know how operations will turn out, right? They want to test the market, and so we will see a few of them, perform business through a branch. But just like Sierra mentioned, we don't see it. And I wanted to emphasize this last bullet point, right? Is in branch. In conducting business as a branch, it's more difficult to justify intercompany charges like management fees, like interest, like royalties under that. Having a legal subsidiary, it just cosmetically looks better to the U.S. tax authorities and is better to justify that. It's not to say that those intercompany transactions will be disallowed altogether. It's just cosmetically better.
Okay, so an employer identification number is something that new companies must obtain from the Internal Revenue Service. These are required for filing tax returns and to identify the company, and they're also required before transacting any business or opening any bank accounts. So you can obtain an EIN by filling out an SS4 form online, by mail, or by fax. But foreigners without an individual taxpayer identification number can't use the online services to obtain this employer identification number.
Yep, this is an important step for starting business in the United States. This employer identification number, as Sierra mentioned, or EIN for short, is the number that identifies the business for all tax purposes, whether income tax or sales tax or payroll taxes or whatever. This is an important step in the formation of doing business here in the United States.
So for corporate income tax, corporations formed in the U.S. are subject to federal income tax on their worldwide income, but they're taxed on their net income. So this is gross income minus the allowable deductions that they can take. The federal income tax rate is currently 21%, but the Biden proposal increases this rate to 28%. Remember that state income taxes will also be added to the federal rates, so the average combined rate is 27% currently.
Yeah, and just to add to that, just to give you a little bit of history, prior to January 1st of 2018, the U.S. corporate income tax rate was 35%, and the average state rate was around 5.5. So U.S. corporations were effectively paying a 40% corporate income tax rate, which was one of the highest corporate income tax rates in the world. And in 2018, with the Trump Tax Cuts and Jobs Act, it lowered the corporate income tax rate from that 35% to 21%. And so now when we layer on the state income tax rate of about 5%, we're at approximately a 27% rate, which in terms of OECD nations, that puts us, I think, at the middle of the pack in terms of the OECD nations. In terms of the G8 countries, with the 21% federal rate, I think only the UK with their 19% rate is lower than us. But as Sierra mentioned, the Biden proposal would increase that corporate rate from 21 to 28%. But when you layer on the state rate, add another 8 or another 5% on top of that. So we're looking at around 33% as the corporate tax rate, which we expect, as soon as the Democrats pass their tax package. Although that's not a done deal. We have yet to see it. It's just a proposal right now. It's not signed legislation. We'll wait to see what the Democrats have in store in terms of the tax plan.
Yeah, this lower rate of 21% though definitely has encouraged new investment and led to a lot more economic growth. So the US has become a lot more attractive for companies to increase like their after-tax return on investment and everything. So US tax law contains the following two-pronged system for taxing the US source income of foreign corporations or foreign persons. So US source investment type income includes dividends, interest, and royalty income, and these are all taxed at a gross 30%. The business tax or the business controlling the payments must withhold this tax. And then if a foreign corporation is engaged in a US trade or business within the United States, the effectively connected income is taxed at 21%. And then we'll talk next about effectively connected income.
Yeah, and so keep in mind, the classic example is, let's say on this first prong that we've got an Indian entity that owns 100% of the stock of a U.S. business, a U.S. C corporation, for example. And that U.S. business generates a profit and it pays a dividend up to the Indian parent. Well, the starting point is that investment type income would require the U.S. corporation to withhold 30% of that dividend as U.S. withholding tax. But then obviously we look to the U.S.-India income tax treaty. And there the treaty specifies that if an Indian entity as the parent owns more than 10% of the US corporation, then the withholding tax is at 15%. If the ownership is less than 10%, then I believe the withholding is 25%. But the concept here is that the US-India income tax treaty would reduce this 30% US withholding down to 15%. So we would obviously look to income tax treaties to see if this starting point of 30% is reduced. So keep in mind that's for investment type of income, dividends, interest, royalties, that's subject to this withholding tax. So, and then just like Sierra mentioned, if a foreign corporation is doing business in the United States, that U.S. sourced income, effectively connected income, is taxed at the same C corporate rate at 21%.
So a U.S. trade or business doesn't have a definition specifically in the tax statute. It's more based on facts and circumstances. So to be a U.S. trade or business, you must have a profit motive and be considerable, continuous, and irregular activity. However, isolated activities don't rise to the level of a trade or business, and clerical and collection-related activities aren't sufficient to be profit-oriented. So to go into what effectively connected income is, generally when a foreign person engages in a trade or business in the United States, all of the income from sources within the US connected with the conduct of that trade or business is considered effectively connected income. And certain kinds of income are treated as effectively connected income if they pass either of the following two tests. So there's the asset use test and the business activities test. So for the asset use test, the income must be associated with the U.S. assets used in or held for use in the conduct of the trade or business. And then for the business activities test, the activities of the trade or business conducted in the U.S. are a material factor in the realization of income. And certain types of income generated through a U.S. office can also be considered effectively connected income. So one of these types of income is rents and royalties that are used for use of intangible property outside of the U.S. derived in the active conduct of a U.S. trade or business. Another type of income that can be effectively connected income is foreign dividends or interest derived in the active conduct of banking in the U.S. And the last type of income generated through a U.S. office that can be considered effectively connected income is a gain from the sale outside of the U.S. of inventory and property held for sale when the sale is made through a U.S. office or a fixed place of business. Okay, so the Tax Cut and Jobs Act revised the 35% corporate rate on effectively connected income to a flat rate of 21% beginning January 1st, 2018. And certain U.S. source income not effectively connected with non-U.S. corporations' business continues to be taxed on that gross basis of 30%. So this includes all the investment type income we've talked about, dividends, interest, and royalties. And I'll turn it over to Joe to talk about U.S. sales tax and some other taxes here in the U.S.
Yeah, so just to give you an overview of U.S. sales tax, so currently there are 45 states that impose a sales tax. The average U.S. sales tax rate today is about 8.5%. Back in 1981, it was about 6.5%. So you can see the increase in those rates. Now, sales tax is a tax that is imposed on the end consumer of a good or service. So it's unlike GST or VAT in that way. From my understanding of GST or VAT, VAT is imposed on every step in the supply chain. Well, that is not true of sales tax. Sales tax is only imposed on the last transaction to the end customer. So, for example, manufacturers a product, sells it to a distributor. The distributor sells that product to a retailer, and a retailer sells that product to an end consumer. Well, sales tax would only be imposed on the transaction between the retailer and the end consumer. It wouldn't be imposed on the transaction between the manufacturer and the distributor to the retailer. It would only be imposed on the retailer to the end consumer. So that's the big distinction between GST and VAT and US sales tax. And generally,
just one doubt here, Joe. Like now, as you said, it won't be from manufacturer to a distributor, and then to from distributor to a wholesaler, from wholesaler to retailer. So there won't be any sales tax here, but it would be only when you are a transact or there is a transaction between a retailer to a consumer. So whether this will not inflate the prices of goods, or whether the VAT which ought to be collected from manufacturer to retailer all gets added up, or it's only one VAT of 8.5% on one transaction between retailer and consumer. So if it is not being charged from manufacturer to retailer, does that mean that it is not at all charged, or it gets all piled up and added at the end when there is a transaction between retailer and consumer? So just a doubt.
Yeah, no, very, very good question. Yeah. The answer is that it is never charged on those earlier transactions. So if the manufacturer sells it to the distributor, the manufacturer does not charge any sales tax to the distributor. When the distributor sells the product to the retailer, the distributor does not charge any sales tax. When the retailer sells it to the end consumer, the retailer charges the 8.5% rate on that final transaction. So there is no charging of sales tax on those earlier supply chain transactions, only on that last transaction. Does that make sense?
Yes. Thanks, Joe. Thanks for the clarification.
Yeah, hopefully that made sense there. In the interest of time, let's keep going. I want to show a map, right? And Sierra and I are going to go into more detail in our next series of webinars on U.S. sales tax. But here I wanted to show you this map, right, of the states that impose a sales tax. And you can see the darker blue states have the higher. The lighter color indicates a lower sales tax. These gray states, Oregon, Montana, New Hampshire, and Delaware do not impose a sales tax there. But you can see, California is just high. Texas is pretty high. We've got some states in the South that's high. Looks like Tennessee's got one of the higher rates there. So you can see that comparison. So the question is when is a remote seller subject to sales tax? And there's been quite a change in the tax law of sales tax. Prior to 2018, in order for a company to be required to collect and remit U.S. sales tax, it had to have what's called sales tax nexus in a state. And nexus is a term that means enough of a connection such that the state can require the company to collect and remit sales tax. And the prior rule was that company had to have a physical presence in the state. And so, going back to our map here, a company under the old rules, would only have to have a physical presence in order to collect sales tax. So that physical presence would mean an employee, ownership of property, inventory, having fixed assets, equipment, furniture, whatever the case would be. That would cause a company to be required to collect and remit sales tax. Well, in 2018, an online seller by the name of Wayfair was selling into South Dakota. And under the laws of the land, Wayfair did not have a physical presence in the state of South Dakota. And so South Dakota wanted to challenge this physical presence rule. And so they created a rule that said, okay, we would like to charge sales tax on out-of-state companies, even though they don't have a physical presence in our state. And we think that if instead they have an economic presence, and that economic presence was defined to be over $100,000 of sales or turnover in a 1-year period or 200 transactions, we are going to cause Wayfair to collect and remit sales tax in the state of South Dakota. And the state of South Dakota knew full well that was against the laws of the land. And so in that case, South Dakota's law went to the Supreme Court, and the Supreme Court ruled in favor of South Dakota. And so now we look to both physical presence and economic presence to see if an out-of-state company is required to collect and remit sales tax. So let's give an example. Let's say an Indian business starts selling remotely into the state of South Dakota, right? People go online and purchase products from the Indian-based company. So now that Indian-based company doesn't have a physical presence in the state, but if its sales are greater than $100,000 annually, or it has more than 200 transactions, that's enough of an economic presence such that the Indian company should collect and remit South Dakota sales tax. And that's true for many of the states. They adopted similar thresholds, although not all of them. California, for example, set their threshold at $500,000 annually. I think Massachusetts has a similar threshold. Texas is at about 250,000. So each of the states set their own threshold, but generally it's about $100,000 of sales or 200 transactions. So hopefully that makes sense. Okay, I know that I want to be cognizant of time. I know that Jugal, we mentioned only 45 minutes. So, we have 2 other webinars that we are going to talk about more in depth and these items. So I want to make sure there's enough time for questions.
Joe, you can take one or two more slides or 1 or 2 more types of tax if there is some time, and we can take that. Maybe after that we can close it. Maybe you can have one more tax after sales tax. It seems there's this capital gains.
Sure thing. You bet. You bet. Let's talk about capital gains briefly. In the United States, capital gains are really gains from the sale of investment types of income. And the policy behind this is that the United States wants to tax those gains at a lower preferential rate to encourage investments. So, right, that's generally, and so, a capital asset is usually an asset on an investment type of asset, whether that's stocks or bonds or real estate. And so here in the United States, Sierra had mentioned that the top individual income tax right now is 37%. The Biden administration would like to raise that to 39.6%. Well, capital gains currently are taxed at lower rates. Those rates are either 0%, 15%, or 20%. So as you can see, much lower than the high individual income tax rate there. And so, right now for C corporations, however, those capital gains are still taxed at the 21%. There's not any benefit for any investment type income at the C corporate level. But for LLCs and partnerships and others, there are those capital gains are taxed at the lower rates. So that's important to know. Let's go on and just do one more slide.
Yes,
here.
please.
I think for our audience today, it's important to note that there is, when paying employees here in the United States, there is for wages on employees, the employer is required to withhold federal income tax for the employee. Also, what's known as federal insurance contribution, which is short for FICA, F-I-C-A. That's in the U.S. There are two components of FICA. There is Social Security. Generally, when retiree people they have paid into this social insurance regime through Social Security, they get this Social Security check to help pay for retirement. And then Medicare. Medicare is also the healthcare system for individuals over 65. And so those two components, Social Security and Medicare, make up the FICA system. And then lastly, employers are required to pay into this federal unemployment tax regime, commonly abbreviated as FUTA. And Sierra and I can get into those. We'll get into those details in later webinars, and I think we'll cover this greater. So I think with that, let's open it up to questions.
Thanks, Joe. There's one more question which we have got. How long will it take to incorporate a company? As you said, you were disregarding partnership and branch for some reason. So let us take it very specific. How much time it takes to incorporate an LLC? And for that, opening a bank account, the average turnaround time.
Very good question. Let's start with the formation of the legal entity, whether that's a C corporation or an LLC. It generally takes an attorney to form that entity. I'd probably say 2 to 3 weeks is the formation time. It can be quicker if there's an urgent need to form that company, but to file all of the paperwork with the state and receive confirmation back from the states, I would give it 2 to 3 weeks. The second part of the question is how long does it take to create a bank account here in the United States? That one is a little bit trickier because the United States, banks here in the United States, they have questions. There are know your client rules that potentially could take a little while. And so when clients ask me that, I say give it at least a month to create a bank account, depending on the bank that you choose, right? And many international inbound clients want to choose a worldwide bank that has operations all across the globe. But many times those U.S. banks will ask, who are the ultimate shareholders? Who are the ultimate individual shareholders of the company? And that can be very tricky when there is institutional investors involved, like private equity or venture capital or a large chain of ownership. And we find that U.S. banks are much more comfortable in issuing a bank account when there's a true physical presence here, when there's a U.S. employee, when there is a U.S. office. When we have a shell company, it's a little bit harder and it takes a little bit longer for the U.S. banks to become comfortable there. So, we tell our clients, allow enough time for your U.S. launch to get a bank account. It's trickier than you think. It's not as easy as many clients think. So take that into account in factoring that into your timeline and your launch.
Thank you, Joe. We have received one question in our WhatsApp group. Any specific sectors or industries in US which we need, which a foreigner, say from India, which we need to eye for, maybe from the tax incentives perspective, like, okay, those sectors enjoy a special exemption, or there are few performance or production based incentives, something like that. So any sector specific in that regard, or it's like one for all for one concept?
No, a very good question. Here in the United States has an incentive called the Research and Development Credit. And that research and development credit is a reduction to U.S. income tax. And so the sectors generally that qualify for that is technology, for example. Generally any technology, software development. So technology companies like Amazon, for example, take advantage of this research and development credit. It's very, very lucrative. But multiple industries qualify for that. We've got manufacturing clients that qualify. Sometimes construction companies will qualify. Technology, medical device, pharmaceutical companies, those generally will qualify for the research and development credit. And the incentive there is the United States is trying to incentivize companies to perform research and development. And that research and development does not need to be new to the universe. It just needs to be new to the company. It needs to be generally technical in nature. And what I mean by technical in nature is it needs to be a hard science like chemistry or biology or computer science, computer engineering, physics. Those type of technical research areas, those industries will get a credit.
Joe, how would you quantify this R&D credit as you were mentioning? How it is quantified, Joe?
Yeah. Well, we take three categories of costs, and those categories are wages paid to employees to perform R&D. And that's the first category. Second category would be supplies used in the R&D process. So those supplies could be prototypes, for example. And then the last category would be payments made to contract R&D providers. If we said, hey, we are going to pay Harvard University to conduct a clinical trial on our experimental pharmaceutical drug, that would be the third category that would be included in that. And so we add up those three costs and we put that into a complex formula. Nothing that the United States Internal Revenue Service does is ever easy, unfortunately. And so it goes into a complex formula and it comes up with a credit. And, I would generally ballpark that credit at between, probably between 8 and 15% of the total R&D spend. So, just to be safe, call it about 10% of the cost of those three categories that I mentioned in calculating what that credit would be.
Thank you, Joe. I think so, Joe, we can conclude here our first session on doing business in United States. As you said, Still, there's a lot, and we'll be covering a bit more chunk of it in our subsequent sessions. Thank you, Joe. Thank you, Sierra. It was wonderful talking to you. Great insights about, I would say, preliminary insights about the various types of constitution, the tax laws, and we'll deep dive in our subsequent sessions as well. So, thank you once again, Joe and Sierra. Hope to see you next week again on something again very interesting, giving more insights about doing business in US.
Sounds great. Looking forward to it. We'll talk with everyone next week.
Thank you, everyone. Thank you, Joe. Thank you, Sierra.
Thanks, everyone.
Bye bye.
Bye-bye.